Breaking geopolitical news is rattling energy markets right now. The US just escalated pressure on Tehran. Treasury officially sanctioned Iran's Persian Gulf Strait Authority, targeting control of the Strait of Hormuz, where 21% of global oil flows daily. Iran uses this authority to levy transit fees and control maritime traffic. Sanctioning it directly threatens approximately 2.1 million barrels per day of throughput. Energy majors Exxon and Chevron face supply risk premiums. Defense names Lockheed Martin and RTX gain on elevated geopolitical demand expectations. Watch W&T offshore for a break above the 200-day moving average resistance and long-term treasuries for any flight to quality yield compression as confirmation signals. This is a material Iran policy shift. Stay long energy and gold. And moving on, we're turning to a story hitting a completely different corner of the market. Shifting now to a seismic geopolitical move reshaping NATO's entire security architecture overnight. Norway announced formal talks to join France's independent nuclear deterrent, ending 75 years of exclusive US NATO reliance in a single move. This isn't symbolic. It directly challenges NATO's $1.3 trillion defense spending framework, driven by deepening European anxiety over US commitment under a potential Trump return. Rheinmetall, Thales, and the EOAD are the direct beneficiaries as Europe's defense industrial consolidation accelerates, and gold catches a geopolitical bid. Track the 10-year bond yield between 2.35 and 2.55%, gold's $200 breakout level, and whether long-term treasuries holds the 4.1% yield floor as flight to quality demand builds. Norway's pivot accelerates European defense spending meaningfully through 2026. Own Rheinmetall, Thales, and EOAD, and hedge with gold and long-term treasuries. Moving on, the bond market just sent its own warning signal that every equity investor needs to hear. Shifting to macro, Wall Street is in a holding pattern ahead of the most important data print of the week. The Fed's preferred inflation gauge hits at 8:30 a.m. Energy Transfer LP Thursday. Consensus expects headline PCE at 2.7% year-over-year, core steady at 2.8%. Core PCE hasn't moved from 2.8% since March. That's the Fed's true focus, and any acceleration shakes confidence that disinflation is on track toward the 2% target. If PCE beats consensus, Treasury bonds, long-term treasuries, and TLH sell hard. Megacap tech NVDA and Microsoft face multiple compression as June cut odds collapse significantly. Track the 10-year yield against 4.25% resistance and 4.10% support. The Nasdaq 100 and long-term treasuries are the real-time scorecards. CME FedWatch June cut odds currently reflect market expectations. A sub-consensus PCE ignites long-duration bonds and growth equities. A beat locks in a Fed hold through June. Moving on, our next story carries even higher stakes for a single sector. Shifting gears now to a geopolitical story with real market teeth. Iran's internet is back online. Iran restored internet access October 9th after an 88-day shutdown, affecting approximately 88 million citizens and costing significant economic losses. The real driver here is oil. Iran sits inside a region controlling 5% of global crude supply, meaning civil unrest directly inflates energy volatility premiums. If stability holds, the energy sector and ConocoPhillips shed their risk premiums. Defense names Lockheed Martin, RTX, and Northrop Grumman lose their regional conflict tailwind as geopolitical tension fades. Watch Brent crude at the $85 resistance level and the VIX band. Sustained reconnection beyond 30 days is the signal that hedges can safely unwind. If Iran stays online, trim Lockheed Martin and RTX longs and reduce gold hedges. Reshutdown means immediate energy and safe haven repositioning. Next up, we turn to a story moving global bond markets right now. Shifting gears now, geopolitics is rewriting global metal trade routes in real time. LME aluminium has surged to $2,650 per ton, driven by escalating Iran-US tensions, adding a significant war premium. Canada is structurally pivoting exports toward Europe, breaking from trade flows that historically sent the majority of output to the United States. Alcoa and Alcoa face margin compression on elevated input costs, while diversified miners Rio Tinto and VALE gain on tightening supply dynamics. Watch LME aluminium resistance near $2,750, And if gold breaks above $2,150 per ounce, systemic risk concerns are firmly in play. Positioned defensively in Lockheed Martin and precious metals, trim cyclicals like F and General Motors. This Canada-Europe pivot signals sustained geopolitical risk ahead. Moving on, our next story hits even closer to home for equity investors.